Investors Chronicle.
Welcome to the Companies and Markets Show, the podcast that gives you expert analysis on all the latest market and listed company news. I'm your host, Dan Jones, and this is what you need to know. We begin today's show with the week's big company news, or non-news, that broke late on Wednesday afternoon. After much speculation, a report emerged that SHEL was in early-stage talks to buy BP. SHEL promptly denied any such talks are taking place, but the speculation continues, and there are also big question marks over both companies' strategies in light of the current oil price. So Alex Hamer is here with us today to discuss all these issues in a moment's time. After that, we ask how you can become a better investor. Many of us will be familiar with the behavioural biases that are common currency nowadays, but how can you actually prevent them from affecting your strategy? Val Cipriani will talk us through some techniques. Lastly, we turn to asset manager Liontrust. Its shares are down more than 80% from their 2021 peak. Is there light at the end of the tunnel? Julian Hofmann and Mark Robinson will provide their thoughts on its full-year figures later on. Let's kick off with BP and SHEL. Yesterday, as we record, so Wednesday this week, the Wall Street Journal reported that SHEL was in early talks over a deal for its rival, which would have created a £200 billion business. That was swiftly denied by SHEL, as I say, which per takeover rules means it can't now bid for the company for 6 months, unless certain things happen, which we might come to. But Alex, why don't you set the scene for us, talk about what's happening with the two businesses in general in broad terms, and whether a takeover might still happen in some form, be it SHEL or another company.
It was much excitement yesterday for about 20 minutes after the Wall Street Journal said talks were on. It was quite a specific story. It said that initially talks between the companies were happening, and then I think a bit more down the line they said bankers representing the two companies were talking. SHEL swiftly denied it, and this morning, so on Thursday, put out a market statement saying we are not in talks with BP to buy it. And under the takeover code, this means they have to sit back for 6 months unless another offer arrives that they want to top or compete with, I should say.
Or there's a material change in circumstances, which is always a very vague term because it does seem to allow for anything to happen. But anyway, that's by the by.
Maybe BP's shares will crash and they could swoop in. That's probably the circumstance that would refer to. But this is the culmination, or not culmination, as you kind of pointed to, of a few months of speculation over whether the two super majors would get together. And this is driven by SHEL's vastly better share price performance. Over the past 6 months, they've split further. I think over the past 18 months, SHEL has performed better as people look at its more consistent profits, stronger balance sheet, and potentially its commitment to oil and gas production, probably leaning more on the gas production into the next few years. And they both had strategy updates earlier this year where SHEL said, we're going to keep doing what we're doing. We think it's working. And BP said, whoops, that was all a bad idea. We're going to just stick to oil and gas now. And that's kind of the way they've come into this situation. There's been stories since early May on whether SHEL would make an approach. It confirmed that it had run the numbers, I think, in early May, and fair enough. These companies are doing the numbers on each other all the time, so that makes sense. That boosted the share price a little bit, but it just hasn't come about that SHEL felt the need to actually make an offer. And the CEO, Val Cipriani, has said repeatedly, and I think in the PR statements as well this week, they underline this again, we find more value in buying back our own shares. This might all be interrupted rudely in 6 months when they think, yep, that's actually given us enough time to put a bid together and work out how we can do this on a cash and share basis. But I think for the moment, it's probably settled. That also leads to the question, who else might come in? We had ADNOC, so is the Abu Dhabi National Oil Company, looking last year, according to Reuters. They've also had a look at some of BP's businesses in recent weeks as well, according to other probably very well-sourced journalists on the beat. They're a player. I think I've also looked at the Americans. So Exxon and Chevron have the most firepower in the space, excluding Saudi Aramco. And out of those two, I would see Exxon as the more likely bidder because Chevron's still tied up in this Hess deal. So that was announced late 2023. They're yet to complete that because Exxon, of all people, got in the way. they have a right of first refusal on some of the assets involved in that. Chevron's still trying to work that out. And also I think the asset mix probably works a little bit better with Exxon. But that's when you come into could this historic British company be taken out by an American major? How would Downing Street feel about that? So, there's a lot of little strands you can pull here. I think they're all quite fun, but yeah, lots to turn over.
On the takeover front, there was some suggestion, I think, the other day that the government is going to loosen the restrictions on overseas companies buying UK assets. So this could be a big test case where that scenario to come to fruition, which admittedly we are several steps away from at the moment. The other reason we're talking about this is because it was only a couple of weeks ago you wrote a piece for us about the way in which the current oil price puts pressure on BP and perhaps Shell as well in terms of their new strategies. Both had capital markets days earlier this year where they set out some new strategies. However, those were based on an oil price that is higher than it is now, and the price has been lower than they would want for some time. The exception to that being immediately after we published the piece, when, of course, the Israel-Iran conflict emerged, caused a massive spike in the oil price, which quickly made us look out of date. And then a week later, the oil price has gone back down and we're kind of back to where we were, making the piece highly relevant again. But can you talk a bit about their new strategies and what assumptions they made and whether those assumptions are actually still going to be fit for purpose if this carries on much longer?
What I looked at in the piece was as you're saying, the assumptions that BP used to reset its strategy over the next few years. And obviously they need to give investors some hard numbers to go with their targets. And this is kind of feeding an oil price and a gas price into their models that give them, the amount of buybacks they can pay. The dividend's fairly set in stone, so they increase that about 4% every year, the quarterly payout. But so the flexibility within that shareholder return is in the buyback. And then the other levers that they have to pull are how much capital spending they commit to each year, how much they want to sell in terms of assets every year. They're currently working to a plan of $20 billion in divestments. And the reason I think the numbers they plug into those assumptions are important is because they seemed wildly out of step with the current oil market. And I think they needed just over $70 a barrel for this all to work out. And I think analysts and investors were already a bit disappointed with the buyback levels. What you get is the potential for further downgrades in both earnings compared to what they've laid out in free cash flow estimates as part of this new model. And then also the reaction to that is a cut to buyback levels. They said just over $70 a barrel when doing this plan. Analysts at RBC are pointing to about $86 a barrel at BP over the next few years. Obviously, that looked not unachievable, 2 weeks ago when everything was kicking off. But with oil prices back down, it does look quite far away again. And I'm aware of the recency bias of this. Oil has been quite weak this year. That isn't a reason for it to continue being weak. But a few of the things that have pushed oil down are long-term factors, including higher OPEC production as Saudi looks to take back a bit of market share. And there's potentially, there's a lot of politics within OPEC as well that are pushing this down. There's also lower demand in China as they shift to electric vehicles and the growth in the economy slows. So there's a few factors like that won't go away too quickly. The actual break even without that, the buyback levels that they put in, is not super, super high. I mean, BP could get away with $62 per barrel oil just in terms of free cash flow break even. And that's actually one of the best numbers in the sector. But it's when you want to get a long way beyond break even and have that free cash flow in order to run the business with a bit more comfort. And the other thing that comes up comparing BP to Shell particularly is the debt levels and them cutting debt to a level that both management and analysts and investors are a bit more comfortable with involves a lot of divestments that have to go right. They're selling big, important assets, but they're selling into a buyer's market. And so that's a pretty tough thing to manage as well.
Castrol being one of those, when there's some concern they won't get the price they want for that as well. That debt issue is an important point when it comes to Shell as well, because if there were to be a situation where its own pretty hefty buyback plans, and which they've been pretty hefty for years now, if they were to be threatened by a low oil price, it could borrow effectively to tide things over in the short term. It's not in the same pressured situation as BP on that front either.
Yeah, and I think they Shell's been quite clear on that because they have that confidence in the balance sheet, and also the reality is it's a volatile industry, and they can smooth out that volatility a little bit with their trading divisions, which are the best in the sector. But there are times where oil goes $60, gas is weak, refining margins are lower, and the trading division can't do much with that, and they will need to borrow to fund buyback levels, which is seen as so important. The other thing to mention with BP is that they have Elliott management on the balance sheet, on the shareholder register, I should say. They don't want greater production. They don't want a massive amount of investment in new products or new oil fields and gas fields. They just want higher cash flow. And that comes through cutting spending, cutting operating costs. So that's also an interesting push now. I mean, they want free cash flow to go up to $20 billion from under 10 at the moment. And that's a pretty stretch goal, but Elliott's a serious operator and has brought on basically what they want fairly consistently in the extractive sector.
Putting all this together, considering on the one hand, you've got the activists agitating for change, there might be some improvements there on that front. There's clearly some takeover interest somewhere, albeit no one's declaring yet. We assume there is at these current levels. At the same time, the company's plans are predicated on slightly better macro environment. What do we consider the valuation situation to look like at the moment for BP?
It is cheaper than the competition. It's funny, I talk about recency bias. At the moment, BP looks like it's bottom of the pile in the oil and gas space. But I don't know, as an investor, that might be the time to jump in. It's hard to say, because I think that's why the debt issue is so important. If BP has to keep putting cash flow that could be going into shareholder returns or higher return capital investment into the debt, then that makes it a dicier proposition. We've had companies fall over from that, a lot smaller companies, I should say. This isn't a huge risk in terms of BP's continued existence, but it does make it just that much shakier than Shell, for example. That is where, if the balance sheet was if the debt levels were a bit lower, I would point to it as an opportunity potentially. Just putting a number on it, I've spoken without too many numbers to try to keep it a bit more narrative, but you look at EV, EBITDA, Shell's 5.2, BP's 4.3. That's the same as Total Energy in France, and still a bit higher than Eni from Italy. On the European side, BP's valued not too much lower or the same as competitors. But when you bring in the US operators, it does look a lot cheaper as well. I don't know. It's a tricky one.
Yeah, that has been part of the issue for investors, hasn't it, as well? They're trying to close that gap with the US operators. I mean, it's caught between two poles, really, isn't it? It has been for a long time, trying to boost its renewable business to an extent, but you've clearly still got a large number of investors who won't touch it because it is a fossil fuel business. And now you've got a large number of people who do buy these businesses who won't touch it because it's doing so much worse than the rest of them. So, yeah, the strategic rethink has happened, for better, for worse, and now it's a question of whether it's actually going to be able to produce.
Dan, could I just interject there as well? Because I just want to touch upon a point that Alex made before, and it is, they're having difficulties with the oil price at its current levels, even though nominally it's still profitable. Part of the reason why both companies have developed their trading divisions in recent years, aside from the fact they've proved to be very profitable from time to time, is they act as an effective hedge for volatility in energy prices. And, that's come to focus in recent times also. Part of the reason why Shell might be interested in BP relates to the latter's US assets as well, because Shell sold off a lot of its unconventional shale operations to ConocoPhillips about 5 years ago. Back in 2022, I think it was, BP completed the acquisition of BHP's unconventional assets in the US. So that would give Shell a decent sort of coverage, and that stands as well as a hedge too, bearing in mind that BP has considerable refining assets over there. To have a high proportion of refining asset provides a hedge when the West Texas oil price is down. That would be another kicker in terms of the deal as well. But ultimately, as Alex said, the rating is so low compared to the US majors, it's going to look pretty attractive. But there is that hedge to take on board, I think.
Completely agree, Mark. I think one thing we didn't touch on too much, and probably a limited time, but the portfolio mix is interesting. So I think there's definitely that onshore portfolio that would be interesting to Shell. Gulf of Mexico would be a real target. But then you look at some of the midstream assets that wouldn't be as popular. I'm not sure Shell's hugely interested in the big Iraq oil fields. And then the duplication of things like the trading businesses would mean that there might be quickly a very profitable set of traders who set up their own shop. There'd be a real kind of split that would come out of any BP Shell combination, which is why I think bankers and analysts have been fairly skeptical that this would get up.
Well, I suspect one way or another, we haven't heard the last of this story, so we will keep tabs on it as usual and see what happens in the months ahead. Maybe by the end of the year, we'll be discussing a different tie-up, or maybe Shell will have returned, as you alluded to there, Alex. We shall see. For now, though, we are going to turn to a different topic. We're going to turn to a topic which should be of interest to all listeners to this show, how to be a better investor. Val, this is viewed through the prism of behavioural investing to an extent. As I said at the top, everyone, or most people by now, would have heard of the likes of confirmation bias, recency bias, as you were talking about, Alex, that kind of thing. But it's easier said than done to actually stop these things from hurting your investment performance. So can we talk a bit about what you looked at specifically for this piece, and then we'll get into some of the lessons and techniques that people can perhaps try to apply to their thinking.
Yeah, when we talk about like behavioral finance or behavioral investing, you often get like the classic list of like biases that people encounter. And I mean, it is very useful, obviously, to be aware of them, because at least, they are a thing and you can sort of try and catch them in yourself when you're managing your portfolio. But I do think that's probably quite hard to do, because quite hard to just like look at the way your brain works and try to stop it or trying to get it to do something different. And also one of the sort of basic principles of this piece is the idea that, investors are human beings, so they will have emotions and they will have like complex psychologies that play into the way they then make decisions. And so it's all about how to change your strategies and the way you invest in a way that, other than, potentially trying to deny these mechanisms, takes them into account in advance so that you can potentially diminish the impact they have on your returns.
And you looked at a specific course in relation to this, which you took the course effectively. Don't know how long that took. There were some things you learned from that, which we'll get to, but one thing I wanted to talk about first up, the idea of the behavior gap. What is that, and what can we learn from that?
Yeah, so it's the idea that there is a difference between investment returns and investor returns, which I think we encounter quite often. Like you try and, model, for example, how much your portfolio might return over a year, over a decade. And obviously that's useful, but it's not quite what then individual investors achieve. And obviously there's a host of reasons for that. There is trading costs, there's taxes, there's, the way you add money, the way you take out money. But then there is also the fact that people are they're not machines. So they tinker with their portfolios, they make changes, they try to time the market, even though they know in theory that they should not be timing the market. And that all of that basically over a long period of time adds up and tends to eat into returns. So this is what the idea of the behavior gap means. And people have made an attempt to quantify it, which I think is very difficult and obviously will be different for each investor. But on just invested assets, the Oxford Risk, which is the firm I took the course from, they think is probably about 1.5 to 2% for the average investor. So that's the returns you potentially renounce to every year by just making those mistakes. I do think maybe that's quite high if you look at, more experienced investors, as our readers tend to be. But even still, even half that over like 10 or 20 years is a lot of money.
The downside of compounding means that loss will itself compound and knock a large amount off your returns, as you talk about in the piece. So what are some of the potential answers to these issues then? One of them, which is quite appealing to us perhaps as journalists, appears to be writing things down.
Yeah, that's right. It's quite an easy one, isn't it? But I think the principle is creating a system when you're feeling calm and rational and you're thinking about things. It's just like creating this system that your emotional self, when you get stressed, when markets are down, when you want to make changes, that you cannot easily work around. And so writing things down, or this idea of like creating an investment constitution, is what that is about. So you just kind of create basically your own investment policy in a way. Just write down a document, like create a document where you write down everything about the way you want to invest. So it's about your goals, it's about your strategy, it's about your asset allocation, it's about potentially some type of assets that you may not want to play with, even though you might find quite interesting or quite fun, but you know that you do not know enough about them to sort of make a bet on them. So you just write it down and you just go like, oh, okay, I'm not going to invest in this. So it's sort of writing down all this kind of stuff and then making a rule for yourself that you will not make changes to your portfolio without comparing the changes you're planning with this document you wrote. And obviously the document can be reviewed, but you don't review it, during a market crash, for example. And the similar idea is the idea of having pause points. So, you can, for example, set a rule for yourself that you're not going to act on any investment hunch or decision for 48 hours, which, is obviously an approach that works for long-term tendency, like more buy and hold investors. But it's the idea that you wait for emotions to subside a bit, and basically you wake up the following day and see if it's still a good idea what you were thinking of doing, and maybe often it isn't actually.
It's all about relying on your past calmer, perhaps better version of yourself, and trying to ensure that your future self doesn't make those mistakes. And as you say, referring back to that document can be useful, because in the heat of the moment, it can be easy to change your mind or think something else. And that kind of sense check, it makes sense that it can be useful. What about confirmation bias, though? Because that's another issue clearly that everyone grapples with. What are some of the potential ways that you can try and limit its effect? And what is confirmation bias as well, for those who don't know?
Yeah, confirmation bias is this idea that, you have an opinion, you have a hunch, you have a belief, and then, you may start to research, you may start reading things, but what your brain tends to do is really focus on the people who agree with you, on the information that agrees with you, and kind of neglect or explain away the counter arguments. And we don't really realize we're doing this, obviously, so which is what makes it so tricky, because you then come out of it with the feeling that a lot of people agree with you, even though on balance it may not be quite true. It's just the way your brain filters the information. And so the way you kind of try to counteract it is, that just like playing devil's advocate a bit. So on purpose try to pay attention or look for opinions, facts that are opposite to your belief. And I think in an ideal scenario, if you know someone who is also interested in investing, a friend, a family member, then you can have that conversation with them, because I feel like sometimes people are quite good at just kind of being more objective than you, especially if it's a subject you feel strongly about.
Yeah, it's interesting, isn't it? Because it just struck me when you were saying that, when we think separately, I mean, this is all about people who are investing and how they can improve. But if you think about people who don't invest, which is a big political or a growing political issue in the country, the government trying to encourage more people to invest, playing devil's advocate with yourself, creating that doubt might, if you're a starter, might dissuade you from getting involved to begin with, mightn't it? But in the context of people who are investing already and making these decisions, it is useful to have that tempering your thought. But
well, I guess like if you're somebody who's doubtful, I think like your opinion will be, I don't want to invest because I'm afraid I'm going to lose all your money. So then you can play the devil's advocate the other way, can't you?
You can role play as a confident investor and give yourself the kick that you might require. Let's also talk about diversification and rebalancing, which we mentioned in the piece as well, because these are things, again, we talk about a lot, we write about a lot, but one of the points in the piece which we don't perhaps discuss very often is that they are quite counterintuitive things. Maybe we do talk about that, but they are also quite irritating and annoying things they can be, and how to kind of recognize that and overcome that.
I really enjoyed this concept because it's quite a simple one if you stop to think about it, but I hadn't really considered it. Is this idea that diversification is unpleasant, and the reason why that is because if you have a well-diversified portfolio, the chances are that most of the time something is going to be underperforming. I think that is especially tricky because that something might underperform for quite a long time, because obviously investment cycles happen, but often they do happen very slowly. And so especially if you have maybe a shorter experience, like if you're younger, you will not have seen, that asset, that sector in particular instead doing well. So it's quite easy, maybe you wait 2-3 years, whatever, and then you go like, why do I even have that in that portfolio? Like it's not helping my overall returns. It's kind of like this idea of being aware that negative feeling, there's a reason for it. And there's a reason why you're diversifying your portfolio, which is that you can't really know in advance what is going to be doing well. So you're kind of hedging your bets, but you really need to think long term in that sense. Rebalancing is kind of similar in it being, a bit counterintuitive and a bit emotionally unpleasant. There's a quote there from an author that calls it like, it's like the flossing your teeth of investing. It's just like something that people don't like. It's good for them in the long term, but people don't like doing. And obviously it's because when you're rebalancing, you're taking money out of something that is doing well, like say big equity run, to put it into something that is not doing so well or that is quite tame, such as bonds. And in a way, it can hurt your returns because you're not running your winners. But then if you don't do it, you end up with a portfolio that doesn't match what you need, doesn't match your risk profile, can make your losses bigger. Presumably you chose your asset allocation in the beginning for a reason. And so, there can be some drifting, but not too much, because otherwise you're just doing something else.
Well, there are many other things in the piece, including the idea of anxiety-adjusted returns, which we won't talk about now. We'll save something for those who seek out the article online in print as well. It's an interesting course, and it's always useful to remind oneself of these biases and, as we've done here, take the next step and try and consider about how to overcome them.
Are you working hard while your savings aren't?
Or are you simply sick to death of girl math memes?
Looking for honest advice about how to make the most of your money and navigate life's biggest moments?
Welcome to the Women and Wealth podcast from Investors Chronicle. We will be discussing life, money, and investing from the perspective of women for women.
Val will use her insight and expertise gathered over her time as personal finance editor at Investors Chronicle.
And Maddie, VIC's digital production journalist, will ask the questions that she and maybe some of you are burning to ask.
In this 6-part series, we'll walk through the various stages of a woman's financial life, and hopefully by the end, all of us will have the confidence and knowledge to make our money work harder for us.
So listen or watch Women and Wealth, the new podcast series from Investors Chronicle.
Available on Apple Podcasts, Spotify, and YouTube.
We're going to wrap up the show, though, with a look at Liontrust, the asset manager that has certainly seen better days, Mark and Julian, because it's been struggling with outflows for a long time now. It rose to prominence on the back of the ESG boom in particular. I mean, there were other strings to its bow as well. It has some strong UK equity funds it's had for a while, but as has been the case with many asset managers over the past few years, outflows have really dogged it for some time now. Mark, why don't you just give us a quick recap of the full year figures it reported for the year to the end of March, which it put out earlier this week?
Yeah, sure. I guess the figure that you mentioned there before is the one everyone looks at, the assets under management. And the greatest outflow from this time around was about £4.3 billion, and that was solely attributable to UK retail funds. It's significant in the sense that their year ended in 31st of March there, because I think sentiment towards UK stocks and broadly European stocks too has improved since then. They also recorded there was a negative investment performance equating to 328 million during that period, which made it just around about an outflow of 5 billion all up there. The chief executive, John Hines, described it as there's an opportunity here, given that there's generational low valuations among UK quality companies, and he's quite right in that there. But it's not reflected in these figures. I guess in a way, it was something of a victim of its own success early on, because it did perform very, very well for an extended period of time, really. We're going to see that administrative expenses, they've taken they sort of focused on those, and they fell by about 27% over the period as well. Their earnings went back into positive territory, even though gross profits fell by 15% to 158 million. So they're doing everything within their limited powers to improve the bottom line there. I would re-emphasize that point, and I don't know if Julian will agree with this, is that because it's got a March 31st cutoff date, we don't really see the sort of nascent recovery in sentiment toward UK equities, which is odd, really, given that the FTSE 100 itself has outstripped many of its foreign rivals this year. I looked at the 250, which is obviously more domestically focused, that hasn't done quite as well. But I suspect that, all things being equal, that it will improve, certainly relative to some of the overseas indexes.
Yeah, I mean, it's a fair point, I think. And actually, I looked this week writing the editorial, and if you consider all major indices from the start of April, so including the Liberation Day sell-off and the rebound, actually UK small cap index has done best out of everything, and that's including large and small caps all around the world. So, I mean, that's an area where Liontrust has investments too, so that should hopefully aid it. But the big question really is whether that improved performance can stem the outflows. And as we've seen across UK active funds in general, there've still been some outflows, I think, certainly at the start of this quarter we're coming to an end of now. So we'll see what happens there. But Julian, I want to get your thoughts on the company. I mean, there's a rebased dividend in there as well, which we can talk about. But what's your general thoughts on Liontrust?
The problem is that they're on the wrong end of quite a lot of trends which are going against them. They're primarily an active manager, whereas investors really have been sticking their money into passive funds over the last 2 or 3 years, hunting for lower costs. There is a limited amount that they can do to make anything any real difference to that. And in my view as well, I mean, they've always had a habit of overselling. There would be an improvement in trading over the past couple of years, and at one point they were pointing to the fact that they had this great relationship with their IFA network, and it doesn't seem to have helped them. I mean, 5 billion outflow is a very significant, probably the largest we've seen in the market over a quarter. And it's only slightly down from the sort of 6 billion they were reporting before. So, there's not a lot of, on the face of it, not a lot of comfort in these results for an investor, other than the fact that you are getting an 18% dividend yield if you think that that's going to stay like that.
On the dividend point, it is now being rebased, and they're going to focus a bit more on buybacks. Dividends going to be proportion of earnings. And now it's going to change. I think it's going to be a minimum of 50% of adjusted EPS. So that will come down. Yeah.
If you want to save cash, that's the way you do it, basically.
Yeah. I mean, I think that yield was so high. I mean, there are some double-digit yielders, including in the asset management space, where actually that's not such a red flag as it was. But I mean, this yield was up at about 15, 19%, as you say. So
I mean, what they could do to change it, I mean, it's a difficult question. And they're not in they're pretty much sharing the same dodgy lifeboat as a lot of the asset managers at the moment. But whether they decide that they have to change their fund strategy, that could be the more decisive sign of a turnaround. Whether that means dumping their active funds and going for a kind of passive focus, that might be one way of doing it. But it's an awkward share at the moment for an investor to say it's going to be a recovery. It's not obvious what that recovery will be, other than there is a general market recovery and people start to put their money again into its funds. I mean, that's the only true measure of a rebound, I think.
I think to go back to the outflows is the point you were making about the size of those relative to the asset base was quite significant even in this quarter, wasn't it? I mean, that's a concern. In terms of new products, they are talking about potentially alternative assets. I mean, that would seem to me to be, it's still difficult to move anywhere, but easier than shifting your whole business to a passive. I mean, I don't think they have the assets to compete with the big players on that front.
Yeah, I mean, unless they put everything into kind of murky private funds or something. I mean, yes, I mean, they're obviously serious about turning around the business, but they're just going to have to wait for the market to turn before they turn.
I'm just looking at the performance of their special situations fund, which has been one which has been popular with private investors, IFAs, over the years. That is still struggling on a year-to-date basis in relative terms, relative to the market. That's the kind of thing they need to see an improvement for, I think, to see those inflows return. That said, they're not a one-trick pony, so if they can get some funds outperforming and the better sentiment we've been speaking about, then maybe there are some better times ahead. It's certainly a situation where the share price has fallen this far that there might be some value starting to emerge, but it's just that lack of catalyst for now is the issue, I think.
Yeah, I mean, I said they had value emerging about 18 months ago, and I thought, that didn't go very well.
There's even more now, yeah, indeed. Many companies in that boat, but with some signs of life for the UK market, perhaps things will improve. Hope springs eternal for them and for other investors, I'm sure. But, I mean, it's a difficult one right now, isn't it, in short?
Yeah, there's not many that are doing well. I mean, you read across, and in this kind of mid-cap, I mean, you can almost call them a mid-cap manager, and their asset base isn't large enough to attract the really big mandates, but then it's also not, it's big enough that if they have large outflows, it looks really, really bad. So they're kind of stuck in an awkward middle ground. There's always the possibility that at some point they might be taken over if the share price keeps falling at a rate that makes sense for someone else to acquire them, but we'll see.
Well, on that note, we have run out of time, so thank you very much to Julian and Mark, to Val, to Alex, to our producer, Vic Thornton. We'll be back next week with another Companies and Markets show.